Good morning, trading world. It is June 15th, 2022, and this is my pre-market outlook and technical analysis for day trading the SPY. Big day today. FOMC announcement today. What to expect and how to position yourself for it. If you have been following my pre-market outlook videos, you know that I have a long-term bearish outlook or I've had that long-term bearish outlook for a long while now. You also know that I think we are in the first stage of what's called a structural or stealth bear market, and that there are at least 4 legs in this type of bear market. Based on midterm time frames, the market is looking to establish a temporary tradable bottom. Let me repeat that. A temporary tradable bottom. It doesn't mean that we are not in a bear market or not headed into a recession. It just means we have exhausted enough energy on the larger time frames that the market has to take a breather. Remember my analogy comparing the market to a runner in a marathon. No runner can run forever, so neither can the market. In marathons, the runner has these planned water break points in which they slow down, almost running in place while rehydrating. In the market's case, that running in place is called consolidation. Just because the Gatorade table is in sight, that doesn't mean we're going to slow down and walk to the table. It's quite possible we give an all-out sprint with everything we got going into this water break area, meaning we could see some really heavy selling pressure or some violent short covering. Now, the FOMC meeting isn't until 2 p.m. However, we have retail sales report at 8:30 a.m. Eastern Standard Time, which could move markets as well. Usually before the FOMC announcement, we have kind of a listless float or algorithmic float that could be up or down going into the announcement. After the possible hiccup from the retail sales report, I'm betting we float up today. Now, the announcement itself, we have basically a 94% chance of getting a 150 to 175 basis point rate hike. Thank the CME Group for the probabilities. Recognize where we are. In just 2 days, or I should say in 2 days into the trading week, we have already broken through the lower edge of the market maker's expected move at around 376 on the SPY. This means we're in dangerous territory. I've spoke about this a lot in the recent past weeks about how market makers have to dynamically hedge once we get outside of that market maker's expected move. And if we're on the low side of that market maker's expected move, they have to dynamically hedge by selling futures. If we're on the upside of that market maker's expected move, they have to dynamically hedge by buying futures. So, to me this morning, it's a given that we're going to rally back up inside of the market maker's expected move. So that means we're going to get at least 376, 377, 378, somewhere in there. We're going to rally till at least there to get us back inside that market maker's expected move. Today, the hourly time frame is the chart in control right now. But I will be watching the 4 hour to get that handoff. Remember, I've quite often used the analogy that the time frames are like runners in a relay race. And they have to run their lap before handing the baton off to the next runner. So the hourly time frame is running with the baton right now, and I'm going to be looking for the baton to be handed off to the 4 hour at some point during the day. And when the 4 hour gets that baton, I'll be looking or paying close attention to the 4 hour chart and its RSI, because this could be the turning point or reversal moment of the day when that 4 hour reaches overbought. So I expect the RSI on the 4 hour to move pretty fast today. Now, waiting for that 4 hour RSI to reach overbought, it could happen during the FOMC announcement. If this happens during the announcement, trying to set up positions manually is going to be super hard, because the market will be moving too fast. So in order to get that order on, it has to be set up on the chart, ready and waiting to go before the announcement. So for example, if you're using Thinkorswim, and we think that the reversal point is going to be at 379 on the SPY. So what I would do, I would set that options up, and I would, whatever option you're buying, we would move that premium until we hit where that option would possibly be when price reaches 379, and have it set up on the chart and ready to go. So that way when it hits that area, you're tapped in and ready to go. Doing this is also very, very risky. So every day I end my pre-markets by saying understand and know your risk, and being okay with that risk. So if you're going to take a position like that, you have to be okay with losing that entire amount. So if it's going to cost $5 for 379 put, you have to be okay with losing that $5. Or what would be even more advantageous is to do a spread. And at that point, if you're looking for the market to rally up and reverse at that point, it's probably better to do a bearish put spread, so that if you pay $1 or $2 for that put spread, you know that that is all you can lose. That $1 or $2, that's what you have on the line. So that's going to be the best way to play it today. And the reason you want that defined risk move is because usually when the FOMC hits, you're going to get a head fake. And usually the first direction that we go is the head fake. So if we take off to the upside, it's usually a head fake, and we're going to go so far up to knock out stops. And if you were playing with a stop loss, you've already lost the game. So that's why we need to use defined risk positions like spreads. And looking at things today, because of the FOMC announcement, expect us to cover the entire range today almost twice. We're going to get a head fake pushing us far in one direction, only to come back hard the other direction. Alright. Now that all of that is out the way, let's get to some key levels for the day. Alright, back with the key levels of the day. Starting on the resistance side, we have our jack resistance at 376 to 378. And then our queen resistance, we have 379 to 381. And this 379 area is going to be a key area of interest. That may be the block off point where we bounce off a few times trying to get through it. And I'm not sure exactly whether we're going to get through it or not. But this is a good place to kind of take a stand at this 379 area. Then we have king resistance, which is going to be the 382 to the 386 area. Now, coming back and around on the support side, we have our jack support at 375 down to 374 area. Then we have our queen support at 373 to the 370 area. A lot of activity is going to bring us back down here today at some point. Then we have our king support from 369 all the way down to the 364 area. I have no idea how bad, if we get some selling pressure, I have no idea of how bad it could get today. But being that we're already outside of the market maker's expected move for the week, it could get very bad, and we could push below this 364 area if we get one of those capitulative moments. So I'm expecting somewhere near in the 360s. Now, the main thesis for today is bearish, closing below the 373.87 with a projected target low of between 370 and 363. It's a very large range because when selling gets going at these levels outside of the expected market move, we could hit free fall. One of the things to expect when we hit free fall, we have what's called market circuit breakers. So if we fall or get to a point where the market moves to a percentage level, if we move 7% down, they will stop the market briefly. And during that stop, they're not going to allow any more selling. You will be able to buy, but there will be no selling or no offers being placed. And the next circuit breaker is 13% down. And the key thing to understand about these circuit breakers is that they are no circuit breakers within the last 30 minutes of the day. So if we start to sell off and we hit 7% down, even 10% down in that last 30 minutes, there will be no circuit breaker. We will continue to sell off. Where was I? All right, I was going over the main thesis, and the target low is between 370 and 363. The alternate thesis is bullish, closing above the 373.87 with a projected high of between 379 and 386. The VIX is still elevated for good reason today. When it is elevated to these levels, it is always possible to see good to see a good portion of both the alternate and main thesis. So be prepared for mind-blowing two-sided trade. We're likely to see a gap up in internals, which could possibly disappear when the retail numbers hit. The current channel we are in is 379 and it goes down to 364. The next channel below is 364 down to 353. Keep in mind, if we go up, the next major channel above is 379 up to 397. This brings us to the scenarios of the day. All right. Our first scenario of the day could be our rounded reversal day type structure. It's the most probable scenario, but not by much today. We could get a continued push higher after a likely pre-market drop, and that continued push higher is going to take us toward the Jack or Queen resistance area. We'll find midday chop either around that Queen or King resistance area, then open up the 2 p.m. hour, which is the FOMC announcement, with a big swing up, then down, before fading the rest of the day. So this is where it's going to be crazy at, and if you're like me, I'm going to be looking to get some shorts off that I already have, and at the same time, I wouldn't mind going in short again, but it has to get us back up above this 379 area, and I'm not sure if we're going to get a chance or get up there before the announcement or during the announcement. So if you get short here before the announcement, understand that there's a risk that you're going to see all of that premium disappear quite quickly. And if things go the way that I'm planning, or the way that it's diagrammed here, we'll have a big drop coming back as well. And I want to see how much of the volatility is sucked out on this head fake up. And this is usually the reason why I try to put orders in on the chart and have them waiting during the announcement. So this is our rounded reversal day type structure. There is a vice versa warning on this as well. There's so many moving parts to the day because of the retail numbers coming out at 8:30. We could have a pop up, we could have a pop down. There is so much moving in today's market. So we have to be very sharp today and on guard for a lot of things. So that's scenario number one. Let's bring up scenario number two. All right, scenario number two is our expanded range day structure. After the retail numbers may send us into a drop pre-market, we could look to set a boundary high around the jack or queen resistance area, and then chopping sideways until our Fed announcement, and then at 2 p.m. we get the big swing up, then down before fading the rest of the day. This is our expanded range day structure, and it has a 33% probability. The probabilities of all scenarios are very close today because of where we are in the range, and because everything is based on a data drop today. So that's our number two scenario. All right, last scenario is our trend day up. We could open gap up, start with a fade back toward the previous close. We find support on or before that previous close, then begin the uptrend for the morning. We find midday chop around either the possible queen or king resistance, and then at 2 p.m. we open up with a big swing up, then down before fading the rest of the day. There's a key thing in common with all of the scenarios because we have this FOMC announcement. And what I should have done before each scenario, I'm going to make some adjustments that are going to count for each scenario. And this is based on what the Fed announces. So give me a moment to bring that up. All right, you have to use your imagination and make this adjustment to each scenario. On the right side of the chart here, I have the basis points rate hike. If we get 125 to 150 basis points added to the rate, the market is kind of prepared and very accepting of that much of a rate hike, and we could see things level off and a rally come behind that announcement. 150 to 175 basis points. The market is accepting of it and is somewhat preparing for it, but the damage that it is going to do to tech will still be so hard on the market that we will still fade behind that to a degree, but not off into the oblivion. 175 to 200 basis points. Anything above that 175 and beyond, it could completely tear into the market and things will go straight downhill from there. So imagine this adjustment on the end of each scenario, because this is the likelihood, or this is what's going to happen at the announcement and during the Fed speak after. So there's no way to chart, the data drop. So this is why we have probabilities. So the probability of where the market goes, if it's just 125 to 150 basis points rate hike, the probabilities of 150 to 175 basis point rate hike, and then down here 175 to 200 basis point rate hike. So again, please understand and know your risk. It is supremely important in conditions like this. Again, the market is searching out or searching for a tradable temporary bottom. And I feel like this announcement is going to help us or move us toward that tradable bottom at some point. It may not all happen today, but over the next few days, I look for us to try to reach that tradable bottom and start on a huge bear market rally that will last not just a couple days, but weeks. So that is it. I hope this helps. Again, please understand your risk, and as always, wishing you a positive trading day. And if you can't take the risk, please sit on your hands. It's not worth losing to a point that you can't come back and play another day. All right. Hope you have a great day.